For some reason, the YouTube isn't connected. I'll check down detector later and see what's going on with that. SPX flip point 6282. Markets are trying to hold the line today, and that is the name of the morning briefing today. All we got to do is just hold the line into next week. We got OPEX next week, and at the end of that OPEX, they're going to remove the guardrails that are holding us into place, and anything goes. But only if we're still within the range that the guardrails have already provided. If we break that, then we won't have to worry about guardrails next week, and we won't have to worry about removing them next week. We will have already pushed through the area where we shouldn't have pushed through. UK, Germany, Hong Kong, all flat. Europe, flat, basically. Start seeing a little bit of push in the Dow at 30. S&P right above that. Small caps more than 0.5% to the upside, and Japan leading the way at 3/4. Keep your eye on that one. That'll be our fire. If we do push, it'll come from that direction. At this point, it's what we have. This isn't going to do anything for us. Just another Fed speaker chipping teeth. Not expecting anything of note there. We don't have big job numbers or big auctions or anything like that. We just have to make it through the day. So as you can see, we're back above the 3-day, the 3-week, the 10-day, the 10-week, the 20-day. We're above all the major moving averages. We're above the volatility trigger, the zero gamma. We got the call wall overhead still, which we hit yesterday and we wasn't able to get through there. It's very likely that, whatever liquidity was there, we didn't absorb it all. It's still there, and we're not going to be able to get through there again today. 46,000 in the overnight comes in a little bit light, almost like we had nations closed around the world somewhere that took away some of the participation. So this movement that we had, although, all things considered, we didn't do much, it was done on a low volume. That was a magnificent bull trap yesterday. Really amazing fake break fast failure. And then right at the end of the day, that little save that ran us right back up again. Now, when you focus on OCR style analysis, every one of these candles gives us an opportunity for things like higher highs and higher lows, and getting a full set, like 2 higher highs and 2 higher lows, without needing an entire swing to get it done. So that gives us this wedge here. The thing about wedges is we're not supposed to get into the apex of it, right? There's like this 20% zone, and that's not a perfect number, but in that range, where it's supposed to be dead space. We don't get into it. The reason for that is if you get something like a rising wedge, for an example, we know that those break to the downside, or a falling wedge breaks to the upside. But if we get into this 20% range, then it throws that out the window, and the direction that we're supposed to go doesn't always play out. You can't trust it to do what it's supposed to do. So we don't want to look at this and say, well, it's a flat top wedge with a rising bottom and have an expectation of a breakdown, because we already went too deep into the wedge. We shouldn't be at this spot. We know it's compression. That is obvious. Everything has gotten tighter and tighter and tighter and tighter, and here we are. We did give up control now, or took control away, if you want to look at it from that point of view. This big bar that's been the boss of all of this is no longer in control. We had tried to break it yesterday and failed and came back in, but we're on the run again today. Now, the day's not done, and we could do just like we did yesterday, and we could fade right back inside the box again. And if we got back down in there, it's possible that that box would still be boss. But at this point, we're out of the box, and it would be more relevant and useful to focus on the new inside that we have, right? So we are inside of this doji bar, and that is the bar of concern right now, not that old one. So we want to maintain a look at yesterday's price action. Don't really need that 786. But 63.80 is the line that we want to keep our eye on, and it's the one that we need to stay above. 63.80 is right here. It's basically where VWAP is at this point this morning. So we need to stay above VWAP at this point. Now, VWAP's going to travel with this. So, at 1 o'clock in the afternoon, we can't say, well, we still need to stay above VWAP. It's 63.80. And if you want to round that up to the closest dollar, then it's 63.81. And that is the line in the sand. It's always about getting out of the box. And at this point, it's simple enough that we got to get out of the Globex range before we get anything else done. There's our Globex high, our Globex low, and we're changing that right now as I speak. Once we get out of this, then we focus on what we had yesterday. RTH high, RTH low. So if we break our Globex range to the upside, that's where we're headed. If we break it to the downside, that's where we're headed. If we get to yesterday's RTH high and we continue to go even higher than that, then we've got all of yesterday. So just another range to get out of. You can add to all of this yesterday's RTH open, yesterday's true close, and yesterday's Globex open. All of those can be levels of interest that you can add to the equation without ever having messed around with any quadrant lines or fib lines or anything like that, right? Just keeping it short, sweet, and simple, focused on yesterday's price action with easy concepts like open, high, low, close. GTFO, we got to get out of the box. Call and put wall didn't change. So we just got to focus on maintaining this structure and not really breaking down or breaking out and losing our guardrails. We have a market maker move this morning, and we just said there's no real economic calendar today of note. So why are they hedging? We know that they are hedging and that this is additional hedging. It's on top of the normal hedges that they always carry. Next week, when we get into OPEX, we're going to see this label almost every single day. And the reason behind that is this label monitors the options that are being traded in the front end. The issue with this is on OPEX week, they are rolling out of those options. So we're going to see a lot of activity, and the indicator mistakes that activity for hedging. So all next week, we're not going to really be able to use that market maker move as any sort of tell for additional risk or for them coming in to hedge. But today ain't next week. So when we see it today, they are in there actively pursuing something to define their risk because they're scared. And we have no idea why. If we did, it would have shown up in the calendar of events for today. Now, it would make more sense, if today was like non-farm payroll, or if we had an FOMC from even another country, right? Like if Europe was doing rates, or if somebody was going on out there of note, but we don't have anything. No reason for them to be in there hedging this morning based on an economic calendar. So it has to be for some other reason. We know that whatever the reason is, it's very likely happening in the morning time. So like at 8:30 or 9 before 10. Otherwise, they wouldn't be hedging so early this morning. The market maker move signal is unique to Thinkorswim. It's right there, by the way, if you don't have the little label. They made it up. So, most brokers don't have it because, well, Thinkorswim is the proprietary creators. Tom Sosnoff and his team, when they were making Thinkorswim, they just made it up out of thin air. If you're on another broker besides Thinkorswim, as long as you have options data, look at the implied volatility average. This is supposed to get higher as you go out. So when the one in the front end is higher than the next one out, then you have a market maker move event. This is implied volatility average. And while we don't know all of the formula that they use to calculate that implied volatility average, because it's proprietary and each broker does it their own way and kind of have their own little take on things, we do know that some of it is based on how much time there is, so a square root of time formula, and then trading activity in the out of the money options, how much size is coming in per trade, and how fast the trades are coming in. All of that is a part of the equation. So it's these out of the money options. And when they get traded really big, really fast, it jacks up the implied volatility average. And if they're doing that in the front end, then we get a market maker move. They are doing that this morning, and we don't even want to try to go in and, figure out which strikes are they trading and does it mean anything? Will it be a magnet? Is it going to take us in that direction? Does it owe us anything? Forget all that trash. This is ES futures. Once the bell rings and we get SPX options and SPY options, these options ain't going to mean anything. But we can still use their trading activity to recognize that they're worried, they're spending money on a hedge, and that we got something coming and we don't know what it is. Hedges for the institutions are different. If you and I hedge, it's basically just a trade. We can protect it, defend it. We're just picking a direction and putting a trade on. It doesn't have to equate to risk or loss. When these guys put on hedges, it is loss no matter what. They are spending money, and if no event happens, the money was spent, they don't get it back. And if the event does happen and we do get a big move, yeah, they'll make some money, but they're still going to have whatever issue based on how much assets under management they were holding that might have been going in the wrong direction. The easiest way to do the analogy is house fire. You can buy house insurance against fire. And if you never get a fire, well, you don't get your money back. Insurance isn't going to, give it back and say, well, you never had a fire, so here you go, take your money back. Yeah, that ain't happening. And if you do get a fire, sure, you'll get the money from the insurance, but it will never make you whole again. You lose way more in the fire than you ever could have insured. Precious things that are just irreplaceable. So if the event happens, yeah, they'll make some money, but they won't be whole. And if it doesn't happen, they're just out of pocket. They won't spend that money if they didn't have a good reason. Problem is, we don't know what the reason is. So that's just a good heads up, right? Watch the news, tread softly, maybe reduce position size, and try to figure out what the heck is coming at us like a freight train that is scaring them enough that they're coming in to hedge. Which is also very likely why we had a low overnight volume. They are sitting out waiting for this event. before they participate in whatever it is that they want to participate in. ADR lines, both are inside yesterday's range, which is great because so are we. So we don't even need an inside day breakout to hit either edge. We're closer to the upper one, not by much, but we are a little bit closer. So by default, we could argue it's more likely we go to the upper ADR line first, since it's the one that we're closer to. But there's no bias behind that, right? It's not like we're bullish today, we're bearish today, we're inside day, we're in the middle of our own Globex range. We got nothing at this point. And the best thing we could do today is absolutely nothing. If it ain't broke, don't fix it. Just go into the close, keeping the guardrails in place. We did not get our MDP from yesterday. We did end up going down there and hitting it. We got close to the weekly pivot. Close don't count. Hand grenades and horseshoes. Now we're back out again. Today's floor pivot is higher than yesterday's. That's bullish. Price opened underneath it. That's bearish. They kind of cancel each other out. But if you look at the trend on the week, floor pivot Tuesday, Wednesday, Thursday, Friday. It's very clear what direction the floor pivots are moving. Each day we've been able to stack it higher than the previous day. Choppy, violent, nasty, ugly, all of that, right? Pick a word. We're still climbing. We're managing to bring those floor pivots up. But we haven't really got very far away from that weekly pivot. Remember, price just travels in a wave. So it's just making that move with some central line in the middle. We're just swinging above and below, and we're not really getting anywhere at this point. If we were to snap a Linreg on there, it would look just about like what I just drew, right? Yep. Now, because yesterday was such an expansion day, just getting to an R and S level would be a heck of a move, right? Because these levels are derived based on how far we moved yesterday, and it's all just math. Now we can see that the S line from yesterday and today, they're almost perfect, right? Tiny little discrepancy between the two. But if we look at R1 from yesterday and R2 from yesterday, we can see a big difference there. The R line for R1 expanded to the upside quite a bit. This is giving us a directional marker that is leaning to the upside. Now, again, this doesn't make price do anything. But that's the bias that the floor pivot is showing. So R1 still inside of yesterday's range, no less, 64.22. We'd have to get it through 63.92 cog line, 6400 options level, then 6411 cog line, and then get up into that R1. Plus we have yesterday's RTH open, the half back of yesterday, the full half back of yesterday, all of those different levels that we'd have to work through to get up and hit this level. What an ugly mess. So the only good thing on the week that we can really say is that we filled in this shallow spot, right? We had that sort of a double distribution last week, and it left that big gapping hole in the middle, and we have filled that in. Yay. Other than that, when we tested the point of control of last week, we did not make it through. We weren't able to keep it. And that brought us back down to our own point of control, which did hold us up. We weren't able to get through that either. And now we're just like a ping pong ball bouncing between these two levels. Something's going to give at some point. The question is, will it happen before OPEX or not? If we break yesterday's low, then we can come back down into that 6250 area and this lower distribution zone from last week. With one day, actually even with a half of a day left for the trading week, since the day's half done already, it's more likely that if we challenge 6250 today, it holds. It would have to be some really negative news to get us down below that level. Ten-day, 30-minute volume profile in TPO. Nothing is really changed here, and we don't have a clear signal. It's not like we got a classic P or D shape. We got distributions all over the place. It's just a real ugly mess. The point of control still over our head and not expected to move anytime soon. And when it does move, it does look likely that it's going to end up underneath us at 63.70. So it would be good if we can stay above 63.70. Otherwise, it's going to be another level that we're going to have to fight through. We have a new VPOC today. Just find one of these older lines. Now I just round mine up to the nearest point, or round it down, whatever. I just get it close to that line by the nearest point. I don't, get down to the very tick. So that's close enough for me. This is a VPOC level because it's a point of control that has not been hit, right? It's a virgin point of control. I didn't name it. Somebody else did long ago with a sick sense of humor. So whatever. Until it gets hit, I'm going to leave that on there. Now, the textbooks will tell you, carry it forward whether it's been hit or not, that you always carry forward the point of control and the value area high and the value area low. I'm not really interested in doing that on a day-to-day basis. I have enough pivots, and I don't need any additional pivots. Now, if you want to do that, there's nothing wrong with it. It's literally what the textbooks will tell you to do. I shouldn't have done that on a 15-minute. Changed it. There you go, 63.48. It's just below 63.50. It's the last line of defense before 62.50. So it needs to hold. And if you look at today's distribution, we're lined up really nice with the TPO. And it's just this wadded up piece of bubble gum at this point. No classic shape, no real, signal in here. If we had a big distribution across the bottom, that would be telling, or across the top, yeah, that would be helpful. But with this classic D shape, no joy, right? There's nothing here of interest. We do have a preview of next week's range. It's not set in stone yet. This weekly expected move indicator previews next week's range early, all day today, actually. But until we go into the close and the implied volatility average quits moving, then this thing is going to move all day long. This gray line is where price is right now. And then this line and this line are going to continue to expand and contract all day based on implied volatility and how many days we have next week. And then we'll go into the close and then they'll lock into place. Like all of these lines back here, they don't move anymore. They're locked. But one thing that we can do on Friday mornings is we can compare the week that we just had to next week's range and see what they're doing with volatility. Now, this week was a unique week, right? Because we had a narrow week last week. And on Friday, we were looking at the week that we have now and had noticed that it was a wide range. that implies that there is something on the table that everybody's worried about, and that is causing volatility within the options. Now, we didn't really get anything though, right? This week it's been mostly just this violent sideways wedge that we've been tightening up into until this morning. We got that market maker move staring us in the face. And next week is already showing as a narrow week, which at first glance makes us think there's really nothing of note for next week. Must not be anything too important. It's a narrow range. Market's not pricing in any volatility. But that's fool's gold. Markets will compress into big economic events, right? Like the phrase is FOMC is volatility suppressing. Volatility is a nerd word for movement. We have OPEX next week and probably quite a few other things next week. The market's concerned about it, and they are pricing in that we're going to go sideways into those events. So this narrow range that we're seeing doesn't mean markets don't think that there's anything of worry next week. They think that there's something big enough next week that we're going to go sideways as we wait for it to get here. The reason this is important is next week we're likely to have hurry up and wait days. Days where we have a sideways Globex and then we get into the RTH and we really don't go anywhere and we reverse off the edges and we get nice reversal trades with no real breakout and run trades until whatever the event happens to be. So next week so far is looking like we're going to have a narrow range week, at least until we get the event. Still holding above the 10-week, everything's fine. This is a good place to be. We're not overextended, and we're not too close to the 10-week. For the 10-day, we're back underneath that 0.5%. So we're still in a good spot, sort of sitting in the like a safety zone. As long as we hover around 0.5% or even a negative 0.5%, then it's like this little zone that we're in. We can just sit here and hang out. It's not a bad thing at all. We can heal, digest big moves, do a lot of things while we just sit here sideways, and it's not negative. Really? Staples? All right. Well, gold miners, staples, a little bit of small cap stuff at the IPO, all having a breakout within the last few days. Some still going, right? Like the miners. And what's sitting on support, airlines, financials, communications, industrials, the Mag 7 complex, Bitcoin. Looking at what's down, we got China down. Mag 7 down, volume is down. China again. A little bit of Bitcoin down this morning, and then China again and again, but these are not at 0.5%, so they need to get lower. We don't want Bitcoin down if you're looking for a rally day, right? We don't want it down either because it's more likely we could break to the downside. But definitely, if you're looking for a rally day, you don't want Bitcoin down. Banks are up, and generically speaking, quote, finance is up. Energy, metals and mining, Mag 7 up volume, robots, chips. Chips need to get more done though. Gold's up, gold miners are up, but junior gold miners are not up. A little bit of a discrepancy there. Keep your eye on precious metals today. So far, what we've got this morning isn't enough to give us a breakout and a drive. Now, we could, get into the regular trading session, get some 0-day options flow, some headlines, some news on whatever they are scared about, whatever they're hedging for. Yeah. Go away. TrendSpider is really proud of their new little sidekick AI assistant, which I haven't used yet, but keep getting all the emails and the little pop-ups. And so we don't have the system in place for a rally based on the things that are up at this point. We would need something else. 0-day options flow, headline news, a change in the names and sectors that are up, something, because what we have right now can't give us a breakout. And really, technically speaking, we don't want that breakout, right? We want to get into OPEX next week, having just digested this move and held steady, get the guardrails removed next week, and then come out of it, and retest all-time highs. I think if we try it early, that we could, break things, remove the guardrails early, and then there's no safety net to catch us if we start to slip. Crude, small caps, healthcare, and then chips. That's not the kind of order that we need to see if we're going to get a breakout day. We'd want chips leading and a lot of these others to be lagging. And the discrepancy with precious metals, something's up there. And then just generically speaking, tech. Bitcoin being down more than 0.5% definitely does not assist us with a rally day. And worse, it threatens a breakdown on the day. All we got to do is stay inside this box. It's a really big trading range, so it's likely that we don't get a test of yesterday's edge to play our reversal trades. So if you want anything to trade at all in between all of that while we wait, then start with the Globex range. And if we escape from that, then play the edges. That's the target, right? And you can, of course, run 111 and 1236 off of either side, so it doesn't matter which way we go. You got a breakout play in either direction. But there's our 111 reversal already. So, if you weren't trading while we were going through this, you already missed the breakout reversal on the 111. So what I got for you guys, watch the headlines, try to figure out what it is that they are hedging for, but they are hedging for something, and keep your eye on it. If they start to unwind that hedge, the market maker move will disappear, right? The numbers will go back in the other direction, showing that they've unwound it because whatever it was they were worried about has passed and they're done. They're no longer concerned. It's time sensitive anyways, so even if they didn't unwind it, it would be gone by the end of the day. Yeah, when I went to upload the Zoom this morning to YouTube, it wouldn't follow through. So I had to just run the meeting without putting it in its playlist spot and putting the thumbnail on it, all the typical morning stuff that I do. If it ended up on YouTube, that's awesome. Now I just have to go and put it in the proper playlist. If it didn't, then I'm going to have to upload it to YouTube and then put it in the proper playlist. But either way, I appreciate the heads up. Hopefully they figure out whatever it is. And it might not have been a YouTube issue. It might have been a Zoom issue. It certainly has issues, especially when they keep adding all these widgets. So it's what I got for you guys. Be careful, be safe, have a good weekend. I'll see you.